Okay, guys, I decided I want to do a quick video on what happened with this young man who was trading on Robinhood doing a multi-legged option trade. There's been a lot of comments around it, and no one has really explained what happened here. And it's interesting how few journalists understand how options work. So we've not seen a decent article on what happened here. Now, I'm going to give you my opinion on what I think happened. Only see what everyone else sees on here. But I have a very strong opinion on what I think is wrong and what I think happened. And I'm going to share that with you today. So my name is Uncle Dan, and I've got a channel where I'm trying to help educate people on the pitfalls and the opportunities in investing, particularly around equity options. And so my goal is to try to help people learn from my 35 plus years of experience on how to avoid the kind of pitfalls like this young man experienced. So I've spent a bit of time looking at what information we know, and this is the problem. Stock assignment in multi-legged options creates confusion because brokers like Robinhood do not inform investors around the context of stock assignment. They send alerts, emails, or you look at your account and you see a negative balance of $700,000 because you got assignment on one leg of your trade. It doesn't mean you've lost $700,000. Investors go into these trades being told by the broker that you have a limited loss multi-leg option trade. The risk you need to worry about is assignment risk, but they don't tell you what that assignment risk is, and they don't give you any context when you do get assigned. So today I'm going to show you what I think happened with his trade, and I'm just guessing, so let me just state that up front. My guess is that he did a trade in Microsoft, and my guess is he did a trade on Wednesday, June 10th, and he did a 3-day expired option trade. He did a put credit spread at the 200 197.5 strike. I'm going to show you what happened on Wednesday, June 10th, and then I'm going to show you what happened on June 11th. And I'm going to show you why he would have been assigned those shares. And if he had done 35 contracts, the assignment would have been for $700,000 in Microsoft stock. Now, his risk was never going to be more than $4,000, and he had an account balance of $16,000. So he did a limited risk trade that had a 50-50 chance of being right. If he was right, he would have made $5,000. If he was wrong, he would have lost $4,000. He was never at greater risk than $4,000. But the problem is that the broker communicated to him that his account balance was a negative $700,000 plus, and he took that to mean that he was down and now owed $700,000. The broker should tell people that because of the trade you put on that the broker can see. I mean, the broker told him when he put the trade on, this is a limited risk trade. But when he gets assigned, the broker doesn't say, hey, look, I know you put this limited risk trade on, but because of this assignment, you're now going to need to exercise the other leg of your trade, and you will incur your max loss of $4,000. But they don't do that, right? They don't give the investor the context around the assignment, and they don't require investors to learn and acknowledge that they understand what the assignment process is. And part of the reason is that you don't get assigned that often. But it's the broker's fault. And this is not the first time that people have had to deal with Robinhood and their lack of providing context around stock assignment. So let's dig down into this, but let me just be clear up front. This issue is about the broker not giving the context around stock assignment for customers with a multi-leg strategy that has limited risk. And they should be on the hook because this is something that's happened more than once. You can go online and search in the forums. There's so many people who have woken up, they saw this negative balance and they don't even understand the context of it. Now, the worst part is if you're a Robinhood investor, you can't call anyone. They offer no emergency phone service to call someone even during normal trading hours. This is shocking news to me. Your only opportunity to try to understand the context of what's happening is to send an email, and that email is going to tell you the expected delay because of the COVID-19 situation. This is unacceptable. There has to be an emergency contact number for a trading desk, the same way you have one with like Thinkorswim, TD Ameritrade, and any other full-service broker. There has to be an emergency contact number for someone who's in a situation that they are completely perplexed about. This can't be something that gets sent off in an email. So anyway, that's my opinion on this. I do not blame him for lacking the knowledge to scrutinize and doubt the information being sent to him by the broker. I would hold the broker 100% accountable for this issue. It's not the first time. They know other people have had issues with it, and no surprise that we ended up in a situation like this. So let's drill down into what I think the possible trade was, and then I want to do a session on what is a put credit spread and how the assignment process works. Right? So let's get on with it. Trying to recreate the scenario where a young man got himself in trouble with a position, didn't quite understand the implications of it, and as a result took his own life. So what we want to do is to understand like what happened. Hopefully we can share this with people. Here's the stock on June 10th. Microsoft is making highs on the day, had decided to do a vertical spread. Now this is all my guess. I don't know for a fact what he did, but let's just walk through a scenario. Let's see if we can get a better idea of what happened. Based upon the news report that he had a $16,000 account, had an exposure of $700,000 or more, I suspect that he went in and did a put credit spread in Microsoft on June 10th at 3:30 p.m. when the stock was at the high of the day. He was able to do this trade for a cost of $5,000. And the buying power effect was only $3,850. He had an account of $16,000, so this was way less than what he could have been doing. So there would not have been any concern from the broker on putting on this trade. The probability of winning on this trade was 50-50. So that was it. Max profit of about 5K, and then he was risking around 4K. Now what happened is the next day, the stock plunged. Okay, so now let's jump forward a day, 3:30 on the Thursday, June 11th. The 200 put and the 200 call, you always look to the other side to know whether you're at risk of being assigned stock on your short. If it's 5 cents or less, then you're at risk of someone assigning you the stock. So the stock was at 187 the next day, and that 200 put was trading at $12. But more importantly, the 200 call was trading at 4 cents, 5 cents. So our young friend was at risk of being assigned, but he still does not have unlimited risk. He's still protected from his long put of 197.5. So the most he could lose on that trade was $4,000. The most he could make was $5,000. So he did not have unlimited loss to the downside. So here's what happened. If he had done 35 contracts and he was assigned, which is what I'm reading in the reports, that his short side was assigned, still one more day to go, then the total value of those shares, if he had done 35 contracts, would have been $700,000. Now, by right, the broker should have said to him, you've been assigned on your short put. Total cost of those shares is $700,000, but you own the 197.5 put. And as your broker, we're going to go ahead and exercise your right to sell the stock at 197.5. And that will neutralize the effect of buying the shares at the 200 strike. That's what the broker should have sent to him. But what I suspect happened is the broker just sent a blank statement on one part of the trade, and that statement was, you owe $700,000 for 3,500 shares of Microsoft. So he probably received a notice like that, which I hear lots of other people on Robinhood receiving the same type of notices, and they freak out. It doesn't make reference to the other side of the trade. And that's a problem with the Robinhood's risk management system. This is not a question about educating people on the weakness of the Robinhood platform. I think Robinhood is just deflecting from their responsibility to build a system that can properly communicate with investors on what's happening with their risk profile. You can't send someone a notice to say you owe me $700,000 for shares that have been assigned to you when you know damn well that there's a long put. People are freaking out because they owe them a bunch of money. It's the inability of their risk management system to properly communicate to the investor what's happening with their risk profile. So anyway, so that's what happened to that position. So in reality, what should happen is should exercise long put, sell Microsoft stock at 197.5. That's what should have happened. So look, I hope this helps explain what happened in this particular situation, so other people will not be confused about what's happening with their position. And until the time when the regulators demand that these risk management systems properly communicate with investors, people need to be alerted to the weakness of their platform. Not that they need to be educated on what their risk profile is. They need to be educated on not trusting the broker. So I hope that helps. All right, next we're going to walk through what a put option credit spread is, and with an emphasis on the assignment risk. Okay, so the put option credit spread is a contract between two people, and it's for 100 shares at two different strikes. Now they call it a credit spread because you actually get money deposited into your account when you put this trade on. They actually pay you up front money. A lot of people like that, to get paid up front, and you get to keep that premium. So the contract is to buy and sell 100 shares, but at different prices, and they call those strike prices. So these spreads have different names. You could be selling a put spread, you're selling a put vertical spread, or it's also called a bull put option spread. You buy a bull put option spread. In this case, we're thinking Microsoft is around 198, and it's a 200 197.5 strike spread, and the expiry was 3 days, and we think this trade was done in Microsoft. Strategy is used when you're bullish a stock and you think it's going to go higher. So Microsoft is trading at 198, and if you're expecting the price to go up, you would consider selling a put option at the 200 strike, which would obligate you to buy 100 shares at 200 if requested. But then you would also buy a put, and it would be a lower strike, like at the 197.5 strike, and that would allow you to sell 100 shares, so you're protected. You have limited risk with this strategy. If you get assigned on the one put, you can exercise the other one and limit your risk. So the impact when you do this trade is you actually receive $1.50, and that gets deposited into your account. So, but you may ask, like, why would you do a put option credit spread? Why don't you just buy 100 shares of stock? When you do this credit spread, they're going to deposit $150 into your account. But if you want to buy 100 shares of Microsoft, it's going to cost you almost $20,000. So there's a big difference in terms of what you got to put out up front. Each strategy will still profit from the stock going up. How and when can you sell it for a profit? Well, the put credit option spread trades on an exchange just like a stock. You can actually get a bid-ask quote anytime. There are market makers and other investors who will happily trade the other side of this trade. So there's a bid and an ask on the spread itself. But when you're selling a credit spread, you still have assignment risk. So what you might find happening is you're going to get some message from your broker telling you that you owe like $20,000 from your short strike on your put spread. But the message won't have any context around how you have limited risk and how you're simply going to be exercising your other strike so that you won't have a risk of 20 grand and you'll only be losing 100. So this can be frustrating if you don't understand what's going on, which is why you need to reach out to your broker. You need to call the trade desk and you need to ask lots of questions, and that's why they're there to help you. So you always call the trading desk with any questions or concerns. Always call them, okay? But what if you get assigned shares through Robinhood? Robinhood doesn't have a phone number for you to call. So you're basically going to have to send an email to these guys to try to understand what's going on, which is unacceptable. I can't believe you don't have a phone number to call Robinhood on. So you're long 100 shares of stock and you're not sure what it means because you have this very vague message. What they should be telling you is, hey, you need to exercise your long put strike at 197.5 to cover that assignment of stock at 200, and because you collected 150, you have a limited risk of $100 regardless of assignment. Don't worry. That's what the message should be. So let's look at the risk/profit payoff graph for this credit spread so that we understand what this defined gain, defined risk strategy looks like depending on where the stock price is. In this example, the stock is down to 188, so we're going to lose money on this spread. But how much do we lose? We know the break even is 198.5 on the spread, so we lose no money there. But we also know we have limited gain at the 200 strike, so we make $150 there. So that's the max gain we make. So even if it goes to 202, we still don't make more than $150. Loss is also limited at the 197.5 strike. Even if we're being assigned stock, it does not change the risk profile of the strategy.